right, welcome everybody. Thank you for showing up to this talk. My name is Cory Fleck. I am the host and president of the Coyle Economics Report. We are a syndicated radio show around the US. And when I first submitted my topic for this conference, it had to be done about 2.5 weeks ago. At that time, the big narrative that I was focusing on for this year, which goes along with a lot of our guests, dealt with the world is in a quantitative tightening program now. It might be slow, but central banks are going through winding back some of their quantitative easing and even slowly increasing interest rates. We even saw that from the Bank of Canada just last week. What I ended up finding over the last 2 weeks was we were actually seeing crucial markets either start to break out or break down, which was further validating the hypothesis of we need a different investing narrative that we have had for the last 9 to 10 years in this huge quantitative easing program that we were in. So first and foremost, just looking at the US dollar. We entered last year, everyone was talking about dollar bull, king dollar. What happened? The dollar fell almost 10%. And it was a pretty straight down move. What we're now seeing, and this has happened just in the last 2 weeks, is a further breakdown in the dollar below some key technical levels. I won't get into the technical levels here, but what is important is that it's trading at a 3-year low. Whenever we see these longer term trends develop on charts, we need to pay attention to them. It won't be a straight move down, but with the dollar continuing to weaken, this is something that we again need to follow through on and watch. We're coming very close to, again, some technical levels, and one of my favorite technicians is actually a CEO of a company, Canamex Gold. If anyone follows some of the technical writings of him, you'll know who I'm talking about. His name is David Vincent. He's been on our show a number of times. This is an interesting chart that he shared with us just last week. Talks about, and again, longer term cycles. We've seen almost a perfect 15-year peak to peak, and it was a lower peak for the US dollar. Now we're moving down. Again, it won't be a straight line down, but some of the targets that he has are very significant, especially for resource investors, and especially understanding the type of investment community that we are in. So again, just a very simple chart that I think if you're not a day trader, I'm not a day trader, I don't recommend being a day trader, but this is one that shows you the trend that the world is going in. Another breakout, copper. We all have been following copper. Copper was very sold off. Again, it's trading at a 3-year high. We're nowhere near the highs that we have been, but when you see this sort of a solid uptrend all in the face of this changing investment narrative, again, that deals with central banks winding back this easy money policy, what we're seeing is money get reallocated. We hear this term capital destruction. It's not actually what happens. Money flows into other markets, and that's why we consistently see US equity markets all-time highs whenever we go through all this money creation, because that money's been distracted. Now what we're seeing is money start to filter into some of these other sectors. Copper, great example. Another sector, oil, also trading at a 3-year high. This is all happening in the first 3 weeks of 2018. When we start to see moves at the beginning of a year like this can very much show us what we're starting to see for the rest of this year. And again, the continuing trends that I think, and a lot of our commentators think, we're going to continue to see. With copper and oil both moving up, and again, the US dollar moving down, this is starting to tell us about inflation. Inflation was on the mind of a lot of people when we were hearing all of this quantitative easing. Yes, the money's going to flow across the board. We're going to get inflation. We didn't really get that, at least from the headline numbers. We got inflation in the US equity markets. Now that the mentality is changing, we are starting to see more of this inflation narrative start to pick up steam. Again, this will be very bullish for the commodities sector, but first and foremost, what I'm trying to show everybody is that don't just look at the commodities in a single vein. Look at what's going on around the world in different key markets. Oil is a huge market, copper is a huge market, the US dollar is arguably one of the biggest markets out there. We can also look at US bonds with the change of, again, monetary policy. Now, the biggest player, the Fed and other central banks, don't have your back, as it's said for the last few years. It was a very easy trade. The more money that was printed, they were buying bonds, government bonds, yields went down, bond prices went up. Less of that is happening. Now we're seeing, again, a level not touched since 3 years ago. Again, crucial. And a cup and handle formation for the technical traders out there. This is usually, again, a sign that bond yields are going to keep going up. Now, I know higher yields usually fly in the face of inflation, but you need to understand where we are in terms of yields. They're historically low. This is a 30-year chart. Yields are still at the very bottom. So a small rise in yields, especially with a continued flat yield curve, this is all leading to a change in narrative from investors. And that's the one thing that we really need to focus on, is where are investors starting to put their money? It's been very simple. For the last 9 years, it's gone into equity markets, it's gone into the bond market. Now we're starting to see this change. And by having certain markets break out from these trading ranges that they've been in, and let's face it, last year, quite a boring year. All we heard was US markets moving up, blockchain, Bitcoin, okay, that was exciting, still is pretty exciting. But the fact of the matter is, when we start to see a change in this narrative, and that again comes a lot from central banks, that is crucial to pay attention to. Interest rates, yeah, they'll probably keep on moving up, but they're going to move up so slowly because central banks really do still want this inflation. This is all coming into a bigger picture here where we are starting to see more and more inflation. Let's look at the gold market. Again, gold very boring through last year, very much range bound. But the important thing about this is we are 2 years off of that low put in 2015. We can look at longer term cycles. Excuse me. But the fact is, when we start to see this change, it's positive. Yes, money isn't just flowing into the gold market, but we're now supported above 1,300. We're looking at 1,375, which was the high in 2016. We need a bit more interest to come in, but with inflation metrics picking up, with investors starting to reallocate some of their funds, the precious metals relative to the overall investing space are undervalued. Investors are going to take more of a value approach now because they have to. It's not an easy game anymore where you follow what the central banks are doing, because they're not going to be putting as much money into the markets. That's the big change that we're seeing. Again, this U-shaped recovery, it's something that we've pointed out a number of times. Where a V-shaped recovery, it's great. It's a lot of fun on the way up. It's usually much shorter lived. A U-shaped recovery, it grinds. It takes time to get going. And it's supported again by this chart where we're seeing very similar parts of this chart from the bottom to the right and to the left. Now we're in a gradual uptrend. One problem, and I hate to say that it's a problem with the gold sector right now, is that the stocks continue to lag. Look at the volume. The volume is back to our 2015 lows. There just isn't that much interest in this sector, except for the fact that certain stocks are moving. It is very much a stock-specific game. You need to be selective out there because we're not in that roaring bull market where everybody's rushing in. If you can position yourself now to get into some of these stocks, you'll do well in the long term, and that's what we like to look at. 2, 3, 4-year outlooks. This is a great time to start buying some of these stocks. I'll point out later, look at the majors. Barrick is trading at, Goldcorp is trading at levels we haven't seen since 2005. So it's telling us that interest is starting to shift and it's being supported by the metals, but for a true bull market, we're going to need stronger stock prices, and that takes more money being allocated in. Right now, there's no doubt there is definitely some money that has been distracted by these hot commodities. Lithium, well, we can again look to blockchain and Bitcoin. Money's been distracted, but one comment that I can make in talking to a lot of my friends, people that don't really have stock trading accounts, they have digital wallets. And the thing that's good about this is it's starting to shift the younger generation, and we need more younger investors in this sector, to getting out of these almost central bank induced bubbles and chasing these trends. They're still chasing the trend in Bitcoin and in blockchain. That's fine. But it's at least giving us the idea and giving these younger people an idea that there are other markets out there, and you know what? They are starting to dabble a little bit in metals and in resources. It's all a long-term game that we're seeing. But first and foremost, back to the gold market shares. we're in a slow market. We need some more interest. We need a breakout. We're still a ways away from the highs put in 2016. You can see that spike, but we just need a little bit more money flowing into the sector. And that then ties into portfolio management for metal stocks. We are all clearly focused on metal stocks here. So some things that you really need to be focused on is management. You hear that all the time, but read through their bios. And when you hear them mention other companies, just type it into Google. Look at the stock chart. Look at what happened to the company. If it was bought out, perfect. It actually, in my eyes, doesn't matter all that much, even at what price it was bought out. Stocks never get bought out at their peak. But if management can show a willingness to exit a position, that's more valuable than anything. Otherwise, they turn into lifestyle companies, and you don't want to be invested in a lifestyle company because the shares won't go anywhere and management will just keep on taking money. For all of those that, for all of you who look into CDAR, which is where all these companies need to publish, at least the venture listed in Toronto listed companies need to publish their reports, search for the information circulars. That is where management has to show you exactly how much they're getting paid. And everyone has their own threshold. See if your threshold is met by your investments. Because if they're paying themselves $600,000 and they're an exploration company, they have no willingness to sell. They're just going to keep stuffing their pockets and maybe later on when they want to retire, offload the company, but it'll be too late for the shareholders then. Also make sure that they have a defined project. You need something. Ask very simple questions. Ask them how they came up with their drill targets. Ask them why they acquired this project. If the answers make sense, perfect. If they don't, and sometimes they won't. Sometimes you'll scratch your head and they'll divert and talk about something else. Just walk away. You don't need to invest in every company. You don't need to invest in every company where management puts some faith in you. You need to figure out what you are more comfortable with in terms of investing and liquidity. You want some liquidity or else you're not going to be able to exit your position. And that goes into, I think, what some of our goals need to be. Paper returns are great, but cash returns, cash is king. Cash returns are better because that then gives you the ability to reallocate some of your cash into different sectors, into even different stocks. Paper returns, again, they're numbers on a computer. Get out while you can. Take some gains when you can. Novo is a great example. We all know Novo from last year. Anybody who bought in and wrote it up felt great. If you managed to sell around $8, even around $6, you're ahead of the game. And if you kept that in cash, buy back now at 3 something, whatever it's trading at. I currently hold shares of Novo. I've wrote it up. I sold a little bit. I've also wrote it down. But the fact of the matter is if you take some money off the table, then you're not going to be mad at management for the stock moving down when sometimes it's not their fault. Also, again, cash returns. This ties into how to maximize some of your cash returns. Buy and sell on a consistent basis just to stay active. It helps you keep up to date with management. It helps you keep up to date with news flow. Make sure they're following through on their promises. What to sell, what to buy. If you have a big gain, again, take some money off the table. If you have a stock that you still like that's pulled back, put some money into that one. It's all about balancing out your portfolio. And for the big gaining stocks that you think still might go higher, put in some stop losses and forget about it, because then at least that will guarantee that you can lock in some stocks. Now, just as a quick note on some of the stocks that I like, again, look at the majors. The majors haven't moved yet to any big extent, and those are the first ones that are going to move. Big money comes into the sector early. Go have a position in at least a couple majors. They've cleaned up their balance sheets. They have better properties. They're more focused, much, much better. If we want to look at some of the junior companies, look at Osisko Metals. Everybody knows the Osisko name. This is their foray into the base metal space. They've acquired 2 massive land packages, all within safe jurisdictions in Canada. They're well cashed up. When Osisko first entered the stock ran. Since that time, the stock has pulled back so much that they had $40 million in the bank and they're a $60 million market cap. So they're getting $20 million for 2 massive, well-known jurisdictions that they hold. All very positive in my eyes. Skeena Resources, for a company that is in the Golden Triangle. This is usually, in all fairness, a bad time to be invested in a Golden Triangle company because they all go quiet. Skeena Resources, they have the SNP mine, the past producing SNP mine. They're currently drilling. They just did a share rollback that they had way too many shares outstanding. They now have under 100 million shares outstanding. It's a much better company in that sense, even though share rollbacks, you know what, they're good for the investors if you come in after them. Quite frankly, they're currently drilling. They've come out with some great drill results. They're going to have consistent news throughout the year and throughout this time, which I think will draw some other people into this stock that have already seen gains in the Golden Triangle and Maple Gold Mines. It used to be called Orvista. I followed along with them. They have a already 2.8 million ounce deposit in Quebec. They have cash in the bank. They have just revamped their whole management team with Ivanhoe guys. They're an impressive team that is going to go out and do something big. They arguably might have too many shares outstanding. They're in about the 200 million range. But the fact of the matter is, they're going to be doing something this year, and that's what you want. If we need to be selective, we need companies that will have news, get the ones that have money already in the bank, and follow along with their news. And as I said, actively trade these stocks. If anybody wants more information or any other companies that I like, we follow a lot on our website that are at this conference, also a lot that aren't even at this conference. We try to take a generalist look at the sector rather than being too gold focused. But hey, it's kind of fun to be gold focused when we're in a bull market. It seems like we are in a slow moving bull market right now. But I hope everybody enjoyed. Have a great conference. Come see me. I'm booth 1109. I'll be around all the rest of today and tomorrow. Thank you.